Alright, today I'm going to have you watch two videos. One of them will be on source documents, and the second one will be in relation to taxes. So I'm going to start with source documents. Now, basically, a source document is any form that provides objective, tangible proof that a transaction occurred. Objective means without opinion, okay? So the actual form, there's no opinion, that's exactly what happened. And tangible means you can actually touch it, okay? So it's any form that provides objective, tangible proof that a transaction happened. So it should be dated and signed, okay, and provide the details of the transaction. Now, what you have to understand is most of these forms have multiple copies. So this one is a cash sales slip. Okay, so it's basically a source document that's prepared when a sale is made for cash. So you'll notice one will go to the customer, one will go to the accounting department, and one will be kept on file. So what you have to just understand is there are multiple copies for source documents. All right. Another type of source document is a sales invoice. And basically, it's a source document that's prepared when a sale is made on account. So cash sales slip records a sale for cash. A sales invoice records a sale on account. All right. Now, there's also a purchase invoice, and a purchase invoice is a source document that's received when items are purchased. Now, it could be on account or it could be for cash. Now, usually there's a little box on it, okay, that indicates if cash was paid or if it was on account. Now, what you have to remember is the sales invoice and the purchase invoice are the exact same piece of paper. They look exactly the same, and I'll explain why. Let's suppose you come into my business, okay? I'm going to fill out a sales invoice, and that sales invoice, one copy I'm going to keep. So that's going to indicate that I made a sale, right? Now that sale could be for cash or it could be or on account. Now, a copy of that sales invoice is going to be given to you, but it means something different to you because you purchased something. So to you, that same exact duplicate copy, it represents a purchase invoice to you, but it represents a sales invoice to me because I sold something and to you, you purchased something. All right. So copies 1 and 2 of a sales invoice are called a purchase invoice by the buyer. I apologize for these markings because the quotation marks got messed up on this particular version of Word I'm using. So you'll see them down here as well. So what I was mentioning is the same source document represents a sales invoice to the seller and represents a purchase invoice to the buyer. Okay. Now, business checks are slightly different than the checks your parents might use. Okay, they're larger. And the check portion is at the top, and the bottom portion is like a details portion that you can rip off. Okay. Now, a check copy is basically what it sounds like. It's a copy of a check that we've written, but we still have on hand. And it's used to record the fact that we made payment, because we're going to use the copy to indicate that we sent payment, because the original one is going to be sent in the mail, right? So we need something on hand to record the fact that we sent payment. So it's a check copy. Now, another source document is a check, because debtors are going to send us or send checks to us, and basically those checks we're going to use to indicate the fact that payment has been received, right? So what ends up happening is it's somebody's job to open up the mail, and what they'll do is they'll open up the mail and they will separate the check part from the details part, and they'll stack all the checks, or someone in the office will run all the checks to the bank, because we don't want those checks laying around, and we'll use the stubs to record the transactions or the fact that we received the checks. Okay? Now, sometimes, or most of the time, the business will, when it gets the check, it will write a restrictive endorsement on the back of each check. And what that does, it's basically a little statement that limits what can be done with the check, right? So they'll write for deposit only into the business's bank account. So account number 12345. Okay? And then the only thing that can be done with those checks is deposit into account number 12345. So they don't have to, it's an internal control procedure. They don't have to worry about the check getting lost or someone stealing the check, because the only thing that can be done with that check is to deposit into that particular account. All right. Now, there's also something called a credit invoice, and you're not going to see, I don't think you'll see any actually. And basically, it's prepared when items are returned by customers, so we'll give them a credit invoice. Now, two that you will see are a credit memorandum or a credit memo, and basically that's a letter from the bank indicating that additional funds have been placed in the company's bank account by the bank. So an example would be interest that you earn on the bank account. So the bank is going to send you a statement or a memo indicating that you've earned so much interest, right? They're not going to, they'll just tell you they've done that. Now, why is it called a credit memo if the business is getting more money? Shouldn't it be called a debit memo? And the answer to that is no. And the reason is your money represents a liability to the bank. So every time you put money in the bank, you're increasing their liability. So whenever you put money into your account, they credit your account because their liability, they owe it back to you. So their liability is increased. And whenever you take money out of your account, they're going to debit your account. So it works opposite of what we do in class, right? So when you put money into your bank account, their liability increases because now they owe you more money. So they credit your account. And again, when you take money out, they debit your account. So a credit memo means that they're putting money into your account for some reason. Right? And the last one is a debit memo. And that's exactly the opposite. It's a letter from the bank indicating that the bank has taken money out of your account for some reason. So it could be like service charges, okay, or bank fees. So they just take it out of your account and then they send you a letter indicating that they've done that. Now, all source documents are pre-numbered and must be accounted for. So even ones that get ruined or you've made mistakes on, what they're going to do is they're going to void those source documents. And it's basically an internal control procedure that prevents theft by employees, because every single source document has to be accounted for. Okay? Now, there is a gap related to source documents, and it's called the concept of objectivity. And it's basically a gap that states that source documents must be prepared for each transaction so as to provide objective, tangible proof that the transaction did in fact occur. So why are we learning about source documents? In the real world, okay, there's not nice little explanations of transactions. So what you're going to do is you're going to use some source documents to record transactions. Okay, so there's a couple of questions I'm going to assign where you are simply going to use the source documents to record the actual transaction. So you're going to have to read through the source document to determine what's actually taking place.